In this video, guys, we're going to look at how important are daily and weekly levels when intraday trading. Hey traders, warm welcome to you. So one for the day traders out there, and this is a question that has come in from a subscriber, and appreciate all you guys who subscribe to the channel. Thank you very much. And also the questions that come in are great and are useful, and hopefully I get to do a video about every single one that comes in if it haven't already been answered in a previous video. So thumbs up for that, guys. Right, okay, so how important are daily and weekly levels when day trading? Great question. I think I'm kind of interpreting this question in this manner is that we have a daily chart, and we've chugged up here on a daily chart, we've chugged down, we've chugged up, we've chugged down, we've chugged up, and we're sort of here, right? And there's an obvious, if I can get a different color pen, this will be better, red pen. We've obviously got a resistance level right here. We've actually got a support level here as well, so I may as well draw that in. So we've got some levels on our daily chart, and the question is this: if you're day trading, i.e. you are starting the day, you're trading in the morning and trading in the evening, whatever it may be, you know what day trading is, guys. How important are these daily and weekly levels? Now, we know that when day trading, we're going to look at the prior day. The prior day's high is very important. The prior day's lows are very important too. The close, any key levels from that, any key levels from overnight if we're trading kind of the S&P and we've had an overnight session. Also further down the week. So we're going to take as many days as we can to get as much trading that's useful. Now, the point about taking these daily and weekly levels are that, let's say we're in a scenario here where we're right in the middle, and these are maybe 5 ATRs away. They're not much use to us because we're not likely to get there in one day. So you may have a really key level, but it's 600 pips away, and you know the average trade, the average range of your day is 100 pips or 100 ticks if we're trading DAX, and it's 600 away. You get the point. The idea is that you don't want to cloud yourself with too much information about really key levels that are just so far away that they're never going to be hit in the day, or unlikely to be hit. You want to be looking at, in that case, you want to be looking at what happened yesterday, the day before, and the levels I can take from that and move forward to the current day's trade. However, let's say now that we, for the next couple of weeks, then we finally start coming up to this level here. At this point now, we need to bring that into our decision-making process for this current day. So whilst it was way away and it was of no interest, now we're approaching it. And let's say we haven't approached this for a good couple of months, so it's not in your kind of 5 days back analysis. But as we're approaching that, we need to be very aware of it. And I have to say, sometimes I've slipped up before when I've forgotten about a level like that, and there's no excuse for it. You should have it as part of your process. Hey, let me just double check the daily, the weekly, whatever it may be, rather than just always checking your last 5 days, your prior day, and just being so focused on that. It makes absolute perfect sense to ensure that you do have the daily chart in your mind, so that you can check it and ensure you're not going to get caught out. So the idea of this is, right, you need to then take that daily level, and some chart package will do this for you, and then print it on or draw it on your intraday chart. So you still have the prior day's trade, you still have the prior 3 or 4 days trade, you're working off that, and you've got your trade ideas. However, this is key, because this is where bigger time frame players are looking. So what you don't want to be doing is kind of taking little piddly long ideas when they're butting up against really serious resistance on the daily or the weekly or the monthly, because that's heavy duty. And when it hits a 1 minute, it's very unlikely just going to go plodding through it as if nothing has happened. It can happen, of course, but it's unlikely. So you've got to then adjust your trading strategy to suit. And that might be, hey, in my trading plan, if I see a long when we're within, I don't know, 20 pips or whatever your idea is of that key level, I'm not going to take it because this overhang is going to really stop me from doing anything. I may well also look for shorts as we butt up to it, even if it's not on a prior day's resistance. Or I may say to myself, you know what, I want to see how we trade when we break through it. If we kind of sit there and it's at midday, maybe I'm going to go a bit short a bit earlier, when before my zone of interest might have been up here. I need to adjust it a bit and have my zone of interest down here because of that significant overhang of resistance. And I think it might fake out, and it might look like a fake out on a daily, that kind of stuff. So it's very important to keep an eye on that. Like I say, I've slipped up myself with this kind of stuff before, but making sure that you bring those key levels over from your daily to your intraday, and then integrate it into your trading. You know, if you have a target, make sure that it's not above that, because if it's above that, then you're looking for a significant breakout on a daily chart, which may be much harder than an intraday chart. And vice versa, you know, if you are looking for a short trade, and let's say it breaks above that and reverses back down, that might be way more weighting on the short side, because you're thinking, hey, that looks like an absolute horrible chart for horrible candlestick for bulls, because it's poked above that daily, come back down. I might even say, okay, well, let me take a short trade there on a short-term setup, maybe a pullback, bear flag, whatever it may be, but I might actually hold that for a day 2 or 3 move. And normally I wouldn't do that, purely because I got a head start on what potentially is a fake out on a higher time frame. So that's the idea, guys. You want to make sure you do your due diligence, if you like, and your analysis on those higher time frames, but being mindful that most of the time they're not going to come into play because you're going to be too far away from hitting them intraday. But when they are within striking range, make sure you have got them on your chart. Make sure you are marking them. You can put some text. Most charting platforms allow you to write a little bit, like maybe a D or something, so you know that's what it stands for, and it's not just a little line. And that, by the way, just digressing slightly, is a danger of having too many lines, because you forget about what's what on this and you can't do anything. That's a key level. Bring it over. Pay attention to it when it becomes in striking range. Anyway, guys, hope this helped. If it has, thumbs up. See you next one. Take care. Bye-bye.